Does this chart give us insight as to where the market's going next? I'll give you a little hint. This is a 20-year Treasury chart. Little risk disclaimer. All right, so not a very eventful week in the market. Today we gapped higher. We're up as far as, I think, like 300 points at some point today on the Dow, and finished right in the same range we've been stuck in for about a week now. So nothing too exciting. The one thing that we've been waiting on is some directionality out of these recent market moves. And so, I recorded some stuff this week talking about how we are still in a downtrend, talking about how if you draw trend lines, you can clearly see where we are. How overall there's still some bearish sentiment, but recently we've seen a lot of activity from the bulls. I watch a lot of stuff on YouTube, and I see a lot of technical analysts per se talking about all these chart patterns and things like that. But before I'm a technical analyst, I'm a trader. I put my money to work, and this is what I do. So I pay attention to, how do I mitigate risk? And the best way for me to mitigate risk is to have some type of idea as to what type of plan I can put forward based on which direction I see the market moving in, and then act accordingly when it happens. Okay, so I don't care which direction it goes in, as long as I can figure out that it's going in that direction and then trade accordingly. But recently, this week, I'm going to zoom in right here inside this box. We're going to get a little bit closer. This is the Dow Jones Industrial Average, the 4-hour chart. I wanted to draw your attention to this right here. These are the recent highs of the Dow. So where we have been stuck, this is as of last Friday, we placed in a high right around 24,750. And so we have not been able to break that recent high. We also put in a low this week, a weekly low here. So we've been range bound. So last week on Friday we came up here, we touched this line. We pulled back earlier in this week. We had a shorter trading week, came back, touched this base, and then we have been entirely range bound. And so today the expectation was we will probably break out of this range to the upside or the downside. And what you can see is we closed this afternoon literally stuck in this range. So the high of the range again was 24,750.22, and we traded and closed at 24,737.20. So we are still stuck in this range. So will we continue the bull move up, or are we going to break out of this range to the downside? In squeezes like this where the price typically consolidates, we see a burst out of one side or the other, okay, typically. So we'll see the price consolidating like this, and then either boom, we'll go up to the upside, or we'll go to the downside. So this is where we can use certain things like range bound indicators. There's a very specific thing I want to show you with regard to the bond market and how the bond market's moving. Specifically, I want to look at the 20-year Treasury here shortly, and I want to show you a way to read that as a leading indicator for the market. But I want to jump into this a little bit deeper first. So when we look at the market, it pays to be agnostic. We don't want to base our trades on what we hope will happen, what we fear will happen. We can only base our trades based on what we are observing is happening right now. And so I want to help kind of digest some of this information and help us to, go into next week looking for a clear direction. So we've been stuck in this range. So what can we use to figure out what's probable to happen here soon? So the first thing I'm gonna jump into is I want to actually pull up a range bound indicator. Okay, so what I'm going to do is I'm going to pull up the stochastic slow. So now this adds a little bit more to the story. So we're looking at price movement, and we're getting not a whole lot from it other than the fact that we're stuck in this range. However, our stochastic slow is at the high end of the range. I'm going to zoom out and show you this really quickly. So you can see when we go over this 80 overbought level, okay, that means that based on recent activity of the stochastics and the strength of these moves, that we are in an area where historically there would be a turning point. So here we're looking very specifically. You see that we're over the 80 level. This led to the downturn. Okay, next when we were overbought again, led to a downturn. Now, just because it goes over 80 does not mean that you're fixing to have a downturn. However, it's more like a yield sign. You know how you look at a yield sign on the highway? It tells you that pretty soon you're going to have to merge into traffic. So that's what this is used as. This is showing you that, hey, pretty soon the next direction is opposite of where we are currently, which is overbought. So that indicator will then digest and go down. So we don't use that in and of itself as an indication to do anything, but it's just one of the tools that we have, one of the weapons in our arsenal, if you will. So if we zoom back in on this information, knowing that, we can see if we're stuck in a range, we are definitely overbought. Okay, so just based on this indicator alone, which we would never trade based on this single indicator alone, but just based on this indicator, we are overbought. So that would tell us that the next direction is most likely to the downside. But there's a little bit more to the story as well. I want to zoom in and talk about something. So what we have is typically there's a counter trend trading methodology in which you look for what are known as divergences. For those of you who know all about this, just bear with me for those while I explain it for those who don't. If we're using it against this stochastic slow indicator, essentially what we're looking for is we're looking for a new high in the price movement. Okay, so if I'm talking about a new high, I'm talking about we have this high in the price movement right here, and then we place a new high right here. Okay, so here's our new high. It's placed right here today. So this high is higher than this high. Relative to this high is higher. Okay, however, this indicator was not able to place a new high relative to its previous high. What that is showing, that's showing inconsistency between the price action and the indicator. This, in particular, this example is a very bearish example. This is setting up for what we know to be as a potential bearish divergence. Okay, so this is known as a potential bearish divergence, and it would give us an indication that the next move should be to the downside. Now, the depth of that move, those are things that we've talked about as I've drawn Fibonacci retracement lines and things like that. And all we can do at this point in time is guess. Hey, the depth of the next move may be down here to the 50% mark. It may be at the 38.2. However, it is down outside of the bottom side of this range that we've been experiencing. Again, and I'll say this a million times, this is not an exact science. There's no way to 100% accurately predict the market. We're just trying to read the story that the price action and the indicators are telling us, and we're trying to act accordingly and put plans in place for the upcoming week for how we will respond to whatever happens. Okay, so right now we're looking at the highest potential that this will actually break out to the downside. Does that mean it cannot go any higher? No. I mean, the market can do whatever it wants. If institutional investors come in and they buy, well then, yeah, we're going higher. We may touch recent highs. However, indications are telling us that that's probably not the case, that we want to see some digestion in these range-bound indicators before we move to the upside. So that's what we're looking at first with the Dow. Alright, so zooming out here, I've added some Bollinger Bands, okay? I'm not going to get into a whole lot of technical jargon about how Bollinger Bands are formed, but essentially you can see that the price of the Bollinger Bands, the value of the Bollinger Bands are at the lower and higher limits of the price action, okay? So we use the Bollinger Bands to give us kind of a gauge of the volatility of the move and where the relative highs and lows should be. And so those Bollinger Bands will change and track in value with price action. So if I add that to the chart and then I actually change this charting time frame to a 60-minute time frame, I want to point this out to you specifically as well. When looking at Bollinger Bands, there is a very popular candle pattern known as a tweezer. Okay, what a tweezer is essentially is an up candle that is followed by a down candle. Okay, so we have a green candle followed by a red candle that is outside of the value of the Bollinger Band. So again, here in this price action that I've highlighted, we have the overbought situation on the stochastic slow, but we also have this candle outside of this red line, which is the top Bollinger Band. When this tweezer pattern occurs, it's a very bearish pattern, which then here you can see led to a move from above the 80 mark to down to the 20 mark on the stochastics. Today, we put in a very similar type of situation. You see this tweezer here, we have the red candle, we have the white I got to get it together. The green candle followed by the red candle, okay, which has led to a little bit of price decrease. We would expect this to lead to even more of a price decrease. So in addition to being stuck in this range, but also being high on the stochastics on the 4-hour chart, we're also seeing this on the 60-minute chart, and we are pairing that with a bearish type of divergence on the 4-hour chart and tweezer patterns on the 60-minute chart. If I come back out to the daily chart, we're at the top range of this Bollinger Band. We have a potential bearish divergence on the indicator. We're overbought on this indicator. So the next probable direction on the daily chart is the same thing. And I still want to point out that we have not been able to break the downtrend. We haven't actually made it to that trend line. So if we were to break out of this range higher, we might touch that trend line. But the thing is the trend line is getting closer and closer and closer to the actual price action. So as the more the price action goes sideways, the closer we're going to come by default to that declining moving average. Jumping over to the SPY, which is just the ETF for the S&P 500. I'm not going to stay here very long. Nothing very substantial has changed, and a lot of what I just explained on the Dow applies here as well. So nothing has changed with regard to the trend, the directionality of that. If we zoom in to the price action from this week, it's the same thing. So if we draw the horizontal line at recent highs, and then we draw another horizontal line and the lows that we've placed in, we hung around this area of about 263 this week. Seemed like the price was hovering around 263. We thought we would have a breakout to one side or the other, and again today's entire candle was contained within that price action. But if we add everything very similar to what we did on the Dow, if we add the actual stochastics, we can see we're in that overbought area. We did not put in a recent high. We did not put in a higher high today than we did earlier in the week, so there is no bearish divergence set up here, but there's a lot of consistency as we go to lower time frames like this. Even the hourly chart is overbought here. We are putting in a double top. It's a very popular charting pattern in which you test in an area of resistance. The price declines, then it retests that area of resistance again. So we're going to see that a lot as we go through the charts. When I take a look at the Qs, same thing. So the Qs are going to have the same range bound indications. We stayed in that range this week. We're still in a downtrend. Everything is overbought. The IWM for the Russell, we're going to have another same situation. Again, it's just I would be telling the same story over and over and over if I were to go through all of this. Everything's set up very, very similar, very consistent across the board. So, I'm going to leave the analysis there for those. There is something else that I want to jump into. There's something else that I want to talk about. I feel like not very many people pay attention to this, and it's something that we really can't afford to take our eyes off of. A lot of people realize that leading indicator, there are a number of leading indicators in which we can speculate against it, we can look at, that will help us determine what we think will be the future outcome of the market or market moves. And people like to look at the financial sector. There's a saying that says, so goes the financials, so goes the market. Other people I've seen use cryptocurrency charts to help figure out where the stock market's going to go, and there's all these types of things. But one thing that I would say is tried and true, no matter what financial advisor you talk to or whomever you talk to about balancing your portfolio, people will always recommend fixed income securities, and specifically bonds. And so when we're talking about bonds and fixed income securities, everyone references the treasury market, or treasury rates, I should say. So I want to flip over real quick to a chart of the 20-year treasury bond ETF, okay? So if we take a look at this gets pretty interesting, and in and of itself, there's not a whole lot going on. One of the things I would show you very quickly is that recently we are in an uptrend. So if I draw a trend line here, you can see that we are in an uptrend that has not been broken. What really makes this chart interesting is when we compare it over the actual S&P 500. Let me show you what I'm talking about. Okay, now you can really start to understand the importance of this 20-year Treasury chart. So I'm going to actually kind of walk you through a couple of things. So here at the vertical line, anything I talk about is going to be referencing the area where the vertical line is that I'm drawing. So if you just take a look here quickly, you can see that when the 20-year Treasury starts to decline here back in August, and we can do this a whole lot. Lots of times the Treasury market moves inversely to the actual stock market. So you can tell that if you look at this top window, this bottom window almost looks like a mirrored reflection, right? And that's just because a lot of times when the interest rates rise, when the Treasury rates rise, the stock market will decline. They have an inverted relationship. Now that's not always one-to-one, and it's not an exact science, just like everything else. However, sometimes moves in the bond market will forecast moves in the actual stock market. So if we take a look back here in August, as I was mentioning before, this decline correlates directly with this increase in price. All right? Right here, at the bottom of this decline, we start to see the bond market moving up. All right? So as the bond market is moving up, here at the very beginning of October, we're seeing this decline in equities in the S&P 500 and specifically. So as we gap up and have this big green candle here in the bond market, we have this huge red candle. And so one of the things that I would point out is that I can argue that we would actually see a turn, and if I were to bring up indicators on the bond market, you could see that those indicators were actually turning here by November 7th. This turn was already occurring in the bond market while the stock market had not turned at all. It was still going straight up. So had we been taking a look at this on November 7th, we could see, okay, bonds, the yields for the 20-year Treasury are actually increasing right now. However, the market is going straight up. Okay, so even though this is a red candle, I want you to pay attention to the fact that, and I'm trying to just kind of draw with my cursor here, that the move was not continuing to move down. It had gone sideways, and the price action had actually started to increase. So at this point in time, there was an increase in price action in the bond market at the same time that there was an increase in price action in the stock market. What this was a leading indicator showing the impending down. So as this started to climb, right here in this time frame, you're going to see the stock market start to decline. Then the bond market goes sideways, starts to decline, and as that's happening, the market goes up. Then the bond market, again, right here at the top of this move, there's no indication. If I were to move this to the right side of the screen, which I may do right here just to show you, all right, right here, there's no indication other than the fact that this is a red candle, and that is a specific candle pattern. I'm not even going to talk about the candles. But there's no indication here that the S&P was turning around. But the bond market, which moves inversely to the stock market, is actually moving up. You see that it's actually turned sideways and it's moving up off of this uptrend line. So on the same day that we have this upward momentum in the stock market, we're having upward momentum in the bond market. They shouldn't be moving in the same direction necessarily. This is an indication that there's some down on the way. And then what do we have the next day? We have a gap higher in the bond market, and then we have a decline in stocks. So I think you get the point by now. So what I'm saying is that we are still in a very, very obvious uptrend here looking at the 20-year Treasury. And this curve is starting to happen. You see this curve? It's curving to the upside. This is gearing up for another move higher on the 20-year Treasury. So what does that historically mean for the market? It means that it's probably a turning point, at least for a little bit. Now, we don't know if the Treasury is going to just shoot up here to the moon. I'm not saying that, but I am saying that if we use this as a leading indicator, all signs are pointing towards the fact that we have not been able to break this uptrend line, and this price action is moving up. Now, today we saw a little bit of a decline, and that correlated with an increase in the actual in the stock market here. But as this turns, and I would urge you to pay attention to this, if this continues to move up and roll higher, we're going to see stocks roll over. That's just how this works. So pay attention to this very closely. And the last thing I'll say about this, and this may be a little bit too far out in time, and I'll probably talk about it more in the future, but support resistance lines. I mention it all the time, but areas that are historically support end up being resistance, and areas that are historically resistance end up being support once they're broken. So you can see this served as a support line in the past. All right, support, it was broken, and then it was tested as resistance. Tested, over and over and over. This is a consistent area of support and resistance. So on this recent decline, so when we had the decline that turned around on Christmas Eve in the stock market, we saw the 20-year Treasury reach this area again, and yes, the Treasury was able to trade and break this area, but very soon after it reverted back. Okay, it reverted back below this area. And so I would say that if the Treasury values were to increase here, it would probably go to this area before stopping and pausing for sideways again. So if we do have a move to the downside in the market, I'm not thinking it's going to be super linear and just knock out recent lows, okay? It's going to be, a time-intensive type of thing. And so if it starts happening, as with most declines, as you can see here, you can study this with any type of market move. It will go in that direction for a little bit. It will pause, move sideways, maybe go against it, and then surge forward again. And we'll have lots of time to assess what's going on, to analyze, to be able to measure against it, and then plan our trades accordingly. So we don't have to try to predict what's going to happen a week or two or months out. What we just have to do is prepare for what the possible outcomes are for next week, and then set our trades up accordingly. So I've only been talking about bearish moves this entire time, so it seems like I'm 100% determined that the market is going to go down, and I know that I can't will the market down, but I can tell you if it's going to go higher, I don't have a whole lot of opportunities to trade that at the moment. Even if I come down to very small time frames, they're all overbought at the moment. It's very difficult to trade to the upside right now. So if the market does go a little bit higher, it's probably going to have to do it without my participation. I'm not saying that you shouldn't trade it, but what's probably more probable, if that's a way to even say that, is that the market would fall. If it's going to go higher, that is that the market would fall and then find support and give us an opportunity to trade on smaller time frames back a little bit higher. However, these indicators don't move very quickly on these larger time frames, and they're not going to change. So as you come over here to next week, that daily indicator is still going to be overbought. The 4-hour indicators are still going to be high on their ranges. We're still going to be next to that moving average line. The declining trend line. We're going to see a lot of that, and so those will eventually have to digest. I can't say that that's going to happen Monday. I can't say it's going to happen Tuesday. But I can say that eventually some of this is going to have to digest. Now, how far that move down is going to be, we will see. We'll play it cautiously. But again, if you manage your risk properly in the trade, and you make sure that you make more money when you win than you lose when you actually lose a trade, then that's the winning formula. Again, remember, this is all about probabilities, random outcomes. We're responding to what actually happens in the market. And so I'm going to talk more in the future about how I specifically put on trades. This range-bound market this week did not hinder me from making plenty of money. And I want to talk more and more about that as I continue to try to explain what I do, how I look at this, and how I stay consistently profitable in the markets. Hope you have a good weekend, and I hope you have a wonderful week next week that is highly profitable.